For investors new to the fund, what does GCP Infrastructure Investments actually invest in, and what role can it play in a portfolio?
GCP Infrastructure invests in UK-based infrastructure assets, so we're funding the private companies that build, own, operate infrastructure assets with a focus on UK infrastructure, so all of the portfolio is based in the UK. The fund focuses on infrastructure that benefits from some form of public sector-backed revenue stream. So historically, the universe of investments has been those sectors that the UK government is seeking to support through long-dated revenue models such as PFI, PPP or renewable subsidies or supported social housing. In investing, we focus on debt rather than equity as part of the capital structure. So we're focused on lending to those infrastructure projects where the repayment of the debt is underpinned by the cash flows generated by infrastructure assets over their lives.
Your portfolio spans 47 investments across infrastructure sectors. How does that diversification help deliver resilient returns?
I think diversification is one of the key competitive strengths of GCP when compared with other infrastructure or renewables funds that focus on a single asset class. The fact historically that we've had an explicit objective of diversifying has meant we've adapted to new interest in support models, or when we've seen sectors mature in infrastructure. If we go back to 2010 and imagine how we thought about solar, a lot of questions we had from investors were, what do you mean there's sun in the UK? How is this going to connect to the grid? How are we going to manage the subsidies? What if it's not built in time? Who's going to operate and maintain them? All risks that have changed because of the deployment over time and as that asset class has become better understood in the UK. That means discount rates come down, the sector becomes more competitive, so the returns available change. GCP's response to that hasn't been to have to continue to invest in that asset class and increase leverage or perhaps go to other geographies. It's been to diversify into new areas and find new attractive asset classes that have a better risk-adjusted return. So I think what that gives investors today is diversification in asset class. So whilst the wind might be shining, wind might be blowing and the sun's shining, you have a diversified exposure in terms of what drives assets and what delivers revenues for those assets. Increasing in the UK, there's been a lot of change to infrastructure asset classes. Increasingly, we're seeing wind and solar cannibalise their own prices. So the fact that we have both baseload assets and intermittent generation in our portfolio diversifies investors' exposure to different subsidy regimes. I think the risk of changes to the subsidy regimes is also, I think, lower because we are exposed to multiple different asset classes. We saw at the start of this year the government changed the indexation applied to the renewables obligation and feed-in tariff. That did have an impact on the company, but it was well diversified across a range of different asset classes, which meant that impact wasn't as high as perhaps it otherwise would have been. So diversification, I guess, as always, is I think, a really effective mitigant of asset-specific risks that fundamentally all infrastructure asset classes are exposed to.
Much of the portfolio benefits from inflation-linked revenues. How valuable is that in today's economic environment?
I think inflation linkage is one of infrastructure's key attractive features. I think the fact that infrastructure assets are real physical assets that benefit from long-dated cash flows means that as part of those cash flows, there has to be some recognition that things change over time, whether that's operating costs or financing costs that an asset might be subject to. Therefore, having a natural hedge in the revenue models for changes to inflation is a sensible thing to do. What that means in a higher rate environment is that there's a natural hedge in terms of the cash flows generated by the underlying projects. Over the last few years, we've seen higher inflation result in higher uplifts to revenues on an annual basis, which perhaps compensates for a higher rate environment and a higher risk-free rate against which ultimately the returns of infrastructure are compared to. So we often compare the portfolio with inflation or index-linked gilts as a sort of benchmark proxy, given that's what the underlying revenue makeup effectively is.
The portfolio currently delivers an 8% annualised yield. How do you balance generating income and protecting shareholder capital?
So both income and capital preservation are two of the core objectives of the fund, alongside diversification, which we touched on earlier. Income, I think, fundamentally is a characteristic of infrastructure. High upfront capital costs that need to be repaid over the life of the asset mean that naturally infrastructure is an effective deliverer of income. It is long-dated, relatively fixed income with some inflation protection which acts as a natural hedge, but it is a long-dated income instrument, which makes it subject to changes in the wider rate environment, and that you do have to take a long-term approach to investing in infrastructure. So income is a natural feature of infrastructure assets. Capital preservation, I think, is equally as important to us. I think there's two aspects to that. The first, infrastructure by its nature is a defensive asset class. It benefits from real physical assets delivering a service to society over a long time frame. That means investors have the benefit of the intrinsic value of that asset and the services it provides. It's really hard to build new infrastructure, particularly in countries like the UK, so actually the barriers to entry mean that competition or substitution of that service or good that an infrastructure asset provides is a low risk. So the monopolistic nature of infrastructure in many cases is a benefit and gives downside protection. I think for GCP specifically, the fact that we focus on debt rather than equity means we're very focused in an investment process on how we get paid back. I think in a debt fund, you make money by not losing money, so how we ultimately get capital return through the cash flows generated by an asset over its life is a key part of our investment process. And I think that provides an additional layer of downside protection. Debt is fundamentally paid back before equity, and equity are taken a first loss position in the assets in which we invest.